Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is product warranties and guarantees. So first of all, please subscribe our channel, like this video if you want to, and like our Facebook page, Accounting Hub by Dr. Scarpin. Your support is very important to us. So product warranties and guarantees. First of all, we have two approaches. The first one is the traditional way. The second one is the cash flow approach. So most consumer products are accompanied by a guarantee such as quality assurance warranty. Cost of satisfying guarantees should be estimated and recorded as expenses in the same accounting period the products are sold. So we need to record an estimation of these warranties and guarantees. And this is a loss contingency. And by the way, if you have questions about loss contingency, we have a video about that, and the video is in our video description. And the criteria for accruing a contingent loss almost always are met for product warranties or guarantees. They are probable, at least part of it, so that's why we estimate our number, and our amount of money is reasonably estimated, so we can record it. While we usually can predict the liability associated with an individual sale, prior experience makes it possible to predict reasonably accurate estimates of the total liability for a period. We are not able to know if that laptop that we sold to Professor Scarpin will break or not. However, we know that 3% of all of our products they break. So and 97 are okay. So we can estimate it. How do we do it based on the traditional way? Let's go to our Excel file. And here, let's delete this one. Here, I have no idea why we have these numbers here. Okay, we have. So let's do it. So here the customer. That is okay. Starting company, my fake company, a supplier of technology products, introduced a new laptop carrying a 2-year warranty against defects. Estimated based on industry experience, because this is a new product, so we have no past records yet. Indicate warranty cost of 2% of sales during the first 12 months and 5% on the second year. During December 2020, its first month of availability, Scarpin sold $3 million of laptops. Very nice company. So 2020 sales, 3 million. So our revenue, cash or accounts receivable and sales revenue, and inventory and cost of goods sold. We don't have this number here. We don't need it. Warranty the first year, 2%. Warranty second year, 5%. So in December, we are estimating that 7% of our sales, we will have problems. So warranty expense, 3 millions at times 7%. That is 2 plus 5. 210. 210. And okay, in 2021, the warranties happens and we are starting fixing or refunding our customers. And on 2021, 123,000 are claimed. So customer claims 130, 123. So this is not warranty expense anymore. We pay our warranty liability. Oops, it's not 210, 183. And our credit is cash or salaries payable, parts and supplies, and so on, whatever we are using to fix these products. Okay? If we are refunding them 123. If we send a technician to our customer home and he was able to fix it, we credit set and salaries payable, or if we replace it, we credit inventory or parts and supplies, etc. Depending on how we are fixing this. So this is the traditional approach. We also have a second one called expected cash flow approach. This is how US GAAP is moving and also IFRS is moving. So this is the new way. However, nowadays, 2020, both are valid. Okay. The traditional way of measuring a warrant obligation is to report the best estimate to future cash flow. However, this method ignores the time value of money, the second year. Our problem is when it is more than 1 year. An alternative expected cash flow approach is described by as fact number 7. Incorporate specific probabilities of cash flow into the analysis. Uh, Optimist scenario, realistic scenario, and pessimist scenario, for instance. Required condition: when the warranty obligation spans more than 1 year, then we have the time value of money, and we can associate probabilities with possible cash flow outcomes. How does it work? Let's go. Same problem here, and assume the risk-free rate of interest is 6% because we need it for our present value. And by the way, if you have any questions about present value, we have a video about that and it is also in our video description. So let's delete these numbers here and let's do it together. So here, 2020, we have these three scenarios here and these three probabilities of happening. So how do we do that? First scenario times the probability of occurrence. And second scenario and third scenario. Just like any project that we are working with. And here we combine them. So our total 84,250. First year, our discounted and undiscounted warranty is the same. Remember here, when the warranty spans more than 1 year. So for the first year, it is the same. And if we are working with present value, we will also have the same number. We will figure it out later. And then here, the second year, the same. So scenarios times probability. So we can copy and paste this formula here. We have it. And we need to combine them. And we have here our undiscounted warrant cost. However, cash flow approach, we need to work with discounted cash flow because we need to incorporate the time value of money. So how do we do that? Let's go formulas, insert function, present value. It is my first here, but you can go here to all or financial and you can find here present value. Do we have here the rate, risk-free rate, 6%. Number of periods, 2 is our second year. PMT, nothing. We are not paying anything monthly. We are paying this one, 124, in a lump sum. We can consider that. Here is 110. Let's do the first one and let's double check if we will have the same number. So here, most recently used, then our p-value will be the first one. Rate, 6%. Number of periods, 1. FV negative. Here we also work with negative numbers for FV because EV and FV they have opposite signs. Oh, we are not having the same numbers. So sorry. Wow. 6% number of periods one. We have it. That's cool. Yes, for sure we have it. Uh, and if we are more than 1 year, we need to do that for both years. The most common mistake, I was committing this most common mistake. So pay attention. And our total sum, first year, second year, 190. And the warranty expense and warranty liability, exactly the same journal entry as the traditional way. Here, warranty expense and warranty liability, warranty expense and warranty liability. And if we have these claims here, 123, we have the same journal entry over there. Let's copy and paste here. And here we have warranty liability and cash, 123. And we're good. Okay, guys, so that's it. Not an easy topic. So take a look at this video how many times you want. Okay. Thank you so much. If you have questions or comments, leave it here or email me at jscrapping@gmail.com. Have a very nice day and God bless you.